have. Anytime you're selling that kind of an interest or making that kind of an offer, you are selling something called an investment contract, and investment contracts are securities. So examples, if you're selling interest in an LLC, you're selling limited partnership interests, you're selling corporate shares or stock, tenant in common interests, any type of passive investment where the investors are passive, they're relying on you to generate that profit. So we talked about what a syndication was, but what's the difference between a syndication and a joint venture? Well, in a joint venture, you could have an investment of money in a common enterprise with an expectation of profits, but everybody who's involved is actively involved in generating their own profits. No one is relying on somebody else to generate the profits. That means there's not one guy who's earning a bunch of fees, who's getting a share of the profits for himself for all the work that he's putting together to make the deal happen, because that truly is the classic definition of a syndicate. So that's the difference. In a joint venture, all investors, all members are actively involved in generating their own profits, no passive investors. So when do you need to follow securities laws? When you're raising money from passive investors, when you're selling interest in your company to passive investors, or if you're repeatedly borrowing private money. If you're just borrowing money from people who are at your local RIA and they're holding themselves out to be hard money lenders, don't worry about them. They have their own laws they have to comply with. Those guys can protect themselves. What I'm talking about is when you are asking your aunt and uncle to invest with you, or your neighbor, or the guy who's sitting 3 rows behind you to invest with you, and he's just got some money in some savings. So those, when you're repeatedly borrowing money from those retail investors, that's when you need to think about complying with securities laws. So what does it mean? What does that mean then? That means you either have to register the offering by getting pre-approval. We don't want to do that, it's too hard. Or you need to choose an exemption, so that's what you will do, is choose an exemption. And then you have to document how you complied with these rules. Think of this like a tax deduction, right? If you want to claim a tax deduction when you're filing your income tax returns, then you can check a box and say, I'm entitled to this deduction. But if you ever get audited, then you're going to have to produce documentation to show why you were entitled to that exemption. If you can't produce the documentation, you don't get the exemption or the deduction. They're going to take that away from you, and they're going to say, not only you owe us this tax, but you also owe us a penalty and a fine, and some interest for the period of time that you didn't pay it. So this is the same way. If you're ever asked, these are self-executing exemptions, you're going to prove how you followed the exemption by keeping adequate records. If you're ever questioned, either by opposing counsel from an investor who's upset with you, or from a regulator who's investigating you, you're going to be able to show them, this is what I did to follow the exemption. And as long as you can produce that documentation, then you're going to be in good shape. So what happens if you don't follow securities laws? Well, you can lose the exemption. You can be sued by investors or regulators. You can be required to disgorge your gains, pay fines. You can be barred from ever raising money again. So if any of you are thinking about getting into real estate investing because you don't like your current job, well, you might have to go back to it, right? So don't go there, right? You can be barred from ever raising money if you don't follow the rules. And you're going to lose your reputation, and the worst case, if you're stealing money or you're allowing somebody in your team to steal money and you're not paying attention, you could end up in jail. All right, so who doesn't follow securities laws? People who don't know, people who don't care, but I also meet a whole lot of people who are in denial, right? They believe, oh, I'm only raising money from my family and friends. I don't need to do anything. That's not true. I'm only raising money from less than 35 people. That's not true. I'm only raising less than $1 million. None of those are true. What those are little pieces of the exemption, but it's not the whole exemption. And there is no such thing as a do-nothing exemption. All the exemptions require that you do something to comply and document how you complied with the rule. All right, so typical exemption rules. Regulation D Rule 506 is the most common rule that our clients use. And the reason is because it's a federal rule and it supersedes all individual state laws. So there are exemptions both at the state level and at the federal level. If you're doing everything in the state of Florida, your property, you, and every investor is in Florida, then you could follow a Florida interstate offering exemption. And there's one up here. I'm happy, you guys can get this off our website at syndicationattorneys.com, or if you want to email me at kim@syndicationattorneys.com, I'm happy to send this chart to you. But the Florida exemptions and the federal Regulation D Rule 506B are very similar. So Regulation D Rule 506B is the one that you'll all use if you're just starting out with raising money. This allows you to raise an unlimited amount of money from an unlimited number of accredited investors and up to 35 non-accredited but sophisticated investors, but you can't find them through any means of general advertising or solicitation, which means that you have to have a pre-existing substantive relationship with those people before you make them an offer to invest with you. So remember when I said make friends? You're making friends. Not only are you making friends, you're talking to them about their investment goals and asking them about what they would like to see in investment. Are they interested in investing in real estate? What type of real estate would they be interested in? You can tell them about what you're doing and just say in general, well, we do this, we buy multifamily, or we buy self-storage, or whatever it is that you're doing. We fix and flip single-family houses in Broward County. You can say that and say, hey, we sometimes have opportunities for investors. Is that something you might be interested in talking about? And then if they say yes, then you start asking them questions about their financial qualifications. Are you an accredited investor? What is your net worth? What is your, and you tell them, look, I don't want to pry. I'm not trying to be nosy, but I'm required to know these things about you before I am legally able to offer you an investment opportunity. And if they say, okay, then at that point they don't care. They're going to tell you. If they're interested in your deals, they'll give you the information. You're going to document that information. From that point forward, you can legally offer them deals. You now have the right relationship to make offers. So that's what kind of relationship you need to establish. Those are the kinds of friends you need to have. So where can you meet investors? At networking events, non-real estate meetups, right? You can join every group around you in your area that you can drive to within an hour and show up every month. We have a podcast that's called Raise Private Money Legally. In it, I interviewed a gentleman who's in his 90s now. His name is Sam Freshman. And I asked Sam, how much money have you raised in your life? And he said, oh, I don't know, like $1 billion. And I said, how did you do that? He said, I just joined every group I could in my local area, and I kept showing up every month for 30 or 40 or 50 years. You don't think you had some friends? He had a lot of friends. He had more investors than he had deals. So if you can do that, people will start to see you as somebody who's credible, that they would like to invest with, and they can start to see your successes. They're going to want to be part of what you're doing. But social events, social clubs, volunteers. Who has the time to volunteer? People with money that aren't busy working every day of their lives, right? Or that aren't busy working every hour of every day. They have time to volunteer. So if you start volunteering, you're going to meet people with the kind of income that can invest in your deals, and then can become repeat investors for you. And guess what? They have friends, right? So widen your circle of friends. So how can you document your compliance? Well, first you're going to pre-vet your investors. So when you meet somebody, you want to have a way to record, and I don't mean like an audible recording. I mean, you want to have a way to take down information about the conversation that you had with them and what they said. When you ask them about their financial qualifications, when you ask them about what kind of things they wanted to invest in, and what kind of returns they were expecting. There's an article on our website at syndicationattorneys.com. If you go into the website, go into our library, select articles, it's the first article that comes up, and it's called How to Create a Substantive Relationship. Everybody who's interested in raising money from private investors should read that article, How to Create a Substantive Relationship. And that article will teach you what to say, how to ask it, and what questions you should be asking investors before you start making offers to them. There are some other options. There's a Regulation G Rule 506C, which does allow you to advertise, but you're not going to do that until you've done enough deals, first of all, that you don't have any more non-accredited investors that can invest with you. And second of all, because when you've done enough deals that you've established a track record. Because the first thing a stranger is going to ask you when you say, hey, do you want to invest in this deal that I have right now? They're going to say, how many have you done before? So until you can answer that question with a correct answer, something like 5 or 6, then they're not going to want to do those deals with you. They're going to want to see you have some experience. So if you don't have that experience yourself, then you need to get it by teaming up with other people that have the kind of experience you want. And then you can talk about the experience of your team. Our team has this level of experience. So that's how you can leverage. The other way to document compliant is to make sure that you have the proper offering documents. And that's something that our firm creates for our clients is if you're going to have any non-accredited investors in your deal, you're going to have a private placement memorandum. It's a disclosure document that describes all the different things that could go wrong with the investment, all the different ways these investors could lose money that are beyond your control. So that if one of those things happens, they can't hold you responsible for it because you informed them of it in the beginning and they went in ahead and invested knowing full well that that could happen. We're going to have a subscription agreement. This is where the investor is going to certify to you that they meet the financial qualifications for this investment, that they met you, in an appropriate way, that they understand the risks, and that they can afford to lose the money. The investment summary is a document you're going to create. You're going to describe in plain English, a marketing piece, what it is that what are you investing in? What are you going to do to it? How's it going to generate a profit? What's got to happen for them to get their money back? And then there's some securities notice filings that we do with the Securities and Exchange Commission and also with the state securities agencies. Yes.
Yeah, is there like an escrow?
So there is something called regulation crowdfunding where you can raise up to $5 million. Anybody can invest, but you're required to do an audit if you're going to raise more than $500,000, and that's going to be very costly, and it's going to be annual audit. You're going to have a whole lot of investors. It's probably going to cost you between $20,000 and $40,000 a year. So it's not really an ideal way for you to raise money for real estate. You can do it for like startups. It's good for startups and things like that where you're not raising a huge amount of money up front. And you also can't advertise it on your own. You have to advertise it through a registered investment portal. There's something else called Regulation A+. That is a public reporting company. So you would graduate to that after you've done a pile of Reg D, Rule 506 offerings, and you decided that you just can't find enough people. All the accredited investors are tapped out. They don't want to invest with you because everybody else has already advertised to them. Then you could do a public offering called a Regulation A+, where you actually do get the pre-approval from regulators, and then you're allowed to offer the interest to anybody in the general public. So how to structure deals with investors. So typical offering structure, where you're going to have passive investors, is going to be 2 LLCs. You're going to have an investor LLC, that's your syndicate. That's going to be a manager-managed LLC. When you form an LLC in the state of Florida, you get to check a box that says it's either going to be managed by members or it's going to be managed by a manager. If you're going to create a syndicate with passive investors, you're going to say that it's going to be managed by a manager. Then the next question that the state of Florida is going to ask is, who is the manager? So then you're going to have to identify who the manager is. You don't want, in a syndicate, the manager is another LLC. We don't want it to be you as an individual because we want to give you as much liability protection as we can. So we're going to create a second LLC that's going to serve as the manager of that syndicate. So that manager entity is itself an LLC. It could be a joint venture because it's you and one other person. You're both going to sign on the loan. You're all doing the work. It could be a joint venture. So we could select either a member-managed LLC there, or we could also select a manager-managed LLC if maybe only one person was signing the loan, but there's 3 people doing the work. So there's different structures that we're going to decide once we interview you and help you figure out what the structure of your deal needs to be to satisfy the lender. so that the lender will actually give you the loan and you'll have the smoothest transaction possible. So this is what's called a specified offering. You have something under contract, you're raising money for that specific thing. If it's a commercial property, you're usually going to be getting a bank loan for some portion of the raise, and then you're going to be raising the rest of it for the down payment, the closing costs, your capital improvement costs, operating reserves, an acquisition fee for yourself, legal fees, and to cover any of your pre-closing expenses. A really good rule of thumb of how much money you need to raise is a third of the purchase price. A third of the purchase price. And that could be going up because as the loan-to-value ratios are fluctuating now with the interest rate hikes, you could have to raise a little bit more from investors in order to get them, make the deals make sense, or to get the bank to loan you the money. Maybe they're not going to loan you 75% of the deal anymore. Maybe they're only going to loan you 65 or 70%. Depends on the deal. So you just imagine you're going to have to raise somewhere between a third or more of the purchase price in order to get this deal to the closing table. You will not use investor funds until you get to the closing table. Until you get to the closing table, it is the manager's funds that are at risk. So the members of your management team should have the money to be able to get the deal to the closing table, paying all the pre-closing expenses themselves, and that could be anywhere from $5,000 on small deals to $100,000 on bigger deals, right? That you need to have amongst your own members of your management team to get these deals closed. So don't passively invest all your own money in your own deals, or you won't have enough money to go do other deals. So this is a blind pool fund. This is a multi-property offering where you would say, instead of buying just one property, here's our business plan. Our goal is to go out and buy 4 properties, and here's what they're going to be like. We're going to buy this, multifamily, 50 to 100 units, anywhere in South or Central Florida, and this is what you're investing in. This is the hardest possible way to raise money. The easiest way to raise money is to get something under contract and to get people to invest in that one thing. And your blind pool fund structure is going to have that investor level LLC, and again, that investor level LLC is going to have a manager. We're just not showing it here, but each property is going to have its own title holding entity that's going to be owned by the investor LLC. So that's how that's going to work. And the property level entity is going to be the borrower on the bank loan. You can do a fund of funds if you want to raise money and invest in other people's deals. It's a tricky subject because it does open up some additional regulatory hurdles that you have to follow. So with a fund of funds, you're still going to have your investor level LLC. I've called it fund LLC here. You're still going to have a fund manager. But your idea is that you're going to invest in somebody else's syndicate as a single entity. So this is a way that you can isolate your investors and invest in somebody else's deals. The problem is that now you're going to be characterized as an investment advisor, and you're going to have to jump through some hoops in order to be able to do that. All right, so if you want to raise money for other people, there are some pitfalls that you need to be aware of. And this is the way a lot of people come to me and say, well, I want to be a capital raiser. It's because they don't know how to go out and find deals. This really is not a viable long-term business option for you. If your goal is to become an investment advisor, then go take the test and become an investment advisor and manage other people's money. How many of you are here to learn about real estate so you can become an investment advisor? Don't lose sight of your goal, okay? Your goal is to be a real estate investor. So you need to learn how to find deals. You need to team with people that can help you find these deals, and you need to be raising money for your own deals and not necessarily raising money for other people's deals. Here's why you have to be careful, because it's illegal for you to earn transaction-based compensation, meaning that you can't raise money for somebody else and get paid based on the amount of money that you've raised, unless you're a securities broker-dealer, which is very, very difficult to become. So you're not going to want to do that. So you can't get paid. So here's an option. You can do what's called a finder's exception. This allows you to only introduce people But you have to be paid whether the people invest or not. Okay, how many of you heard that Kim Kardashian got in trouble for securities violations?
Yes.
Okay, here's why she got in trouble. Because she got paid $250,000 to go broadcast over her social media networks about a crypto offering, but she didn't disclose to the investors how much she got paid and that she was being paid, so that's what she got in trouble for. So, but she was going to get paid $250,000 whether a single person ever invested in that crypto offering. So that's the finder's exception. All she was doing is saying, hey, you like this deal, go talk to these people. The only thing she did wrong was not saying how much she was going to make. Some states don't like the finder's exemption. There was a proposal in the Trump administration to try to allow a finder's exception, but it definitely got killed by this current administration. California, if any of you are from California, does have a finder registration and a real estate broker exception that does allow you to refer people to California deals and get paid a commission. It's the only state that has it. Okay, so you want to be careful of acting as a finder. Most people aren't going to pay you unless you're an influencer like Kim Kardashian, or if you have a database of 300,000 people or something like that that you can broadcast their deals to, and then you want to pay them some kind of a fee. Just make sure they disclose that, because you can get in trouble for also not that they didn't disclose it. How can you legally refer your investors to somebody else's deals? You can JV with others at the management level, so you become part of that manager LLC. You need to give yourself a role in management other than raising money and actually do it. So the rule is that you can't get paid for the money you raise. Everybody in management has a role of raising money. They all get paid for what they do in management other than raising money. You can refer your investors directly to somebody else's deal. If you want to make sure that they're not going to go try to harvest your investors for their future deals, then you can use a non-disclosure or non-circumvent agreement that will deter them from wanting to do that. And so again, this isn't a sustainable model. You're only going to do this to get some credibility, to be in other people's deals, to call yourself part of the management team, and to get some experience from those other people until you can do your own deals. So, what are the other jobs that you can do? There's a whole list, take a picture of this, of all the different things you can do in management to earn money besides finding deals or just finding investors. So here's some amateur mistakes. Don't try to chase single check writer investors. It's a waste of time and effort. Okay, because they're usually going to be too polite to say no, so they're going to string you along until it's too late for you to find any other investors, and then you're going to lose the deal. I've seen this happen again and again and again. Or they'll say right at the end, they'll stop talking to you, they'll just stop answering your calls. Or they'll come back and say, well, I would do this deal, and it's, realize you've been stringing along with this guy for, 6 weeks now, and you're 2 weeks before closing. I would do the deal, but I just don't like the terms. I think we have to renegotiate. You're going to get 1%. Okay? Wasn't worth it for you to do the deal. So don't try to chase whales. Don't try to go after single check writers. The people that will allow you to stay in control of your deal are people who will write $50,000 or $100,000 checks and come as part of a group. So think of this like you're fishing for tuna, not whales. Okay? A whole lot of smaller investors are going to let you keep control of the deal, and they're going to count on you to generate the profit for them. They're not going to be worried about their money. Somebody else who's going to put in $2 or $3 million into your deal, guess what? You just bought yourself a boss. How many of you wanted to come here today to learn how to find a new boss? Yes, right? I don't know about you, but I'm unemployable. That's why I'm unemployed. All right, so just be careful of giving any single investor too much control over your deal. The other thing is, no one's an investor until their check's in your bank account. Okay? Do not hold up deals for anybody that says, I'm getting the money. Just say, that's great, let me know when you have it, and when you're ready to send it, I'll let you know if there's still spots left in our deal. Just keep raising money. Don't wait. I had a client last year that waited for a $400,000 investor to come to the closing table. They probably spent $75,000 or $100,000 getting that deal that far. That person never came. Okay? Don't fall into that trap. No one's an investor till their check's in your bank account. Until then, you're just having a conversation. So just thank them for their time. Tell them, let me know when you got the money, and we'll see if we still have a place for you. Beware of hiring the wrong securities attorney. I think we're all convinced that if we're ever going to do a probate deal, we're going to hire Al, right? Yeah, I'm never going to go anywhere else with Al, right? So hire the people that have the right expertise for what it is you're trying to do. Don't wait too long to hire a securities attorney, because if you do, then you're not going to have time to raise the money. It takes time to put these documents together, and it takes time for you to raise the money. If you want a syndicated deal, and you're going to, a good comfortable raise for people that have never raised money before is $1 to $2 million. Don't try to go out and find deals where you have to raise $5 or $10 million if you've never raised money before. You're not going to be able to do it. You want to raise $1 or $2 million on your first raise, but you also want to be cultivating relationships with people and making friends with people now, so that when you have a deal, you're not concerned. You know you can close it. So typical deal for syndication takes about 90 days, right? You're going to have some period of time. You're going to have to do some due diligence. And while you're doing that due diligence, we're going to be working on the paperwork. So what we tell our clients is hire us when you have a signed purchase agreement. Someone from your team has physically been to the site and you've reviewed the financials. Once you've done those three things, our statistics show you are 85% likely to close on that deal. So that's a pretty good odds. At that point, hire us. We're going to start working on your docs right away. Ideally, you should close your due diligence, and we should be done with the documents at the same time, leaving you another 45 to 60 days to be able to raise that money and process your bank loan. All right? Don't pay finder's fees or commissions. If you're going to do that, make sure you're doing it with advice of counsel, and that you have the right agreement with those people. Don't hire consultants whose job it is to raise money for you. Be careful, because you could lose your exemption, and you could be charged with hiring an unlicensed broker. And then don't advertise when you shouldn't, right? I see people all the time saying, I'm looking for joint venture partners, but they're really not, because those joint venture partners are not going to be active. They're going to be passive. So it's not what you say, it's what you do and how you behave that's going to determine whether or not what you're doing is called a security. A former securities commissioner was once asked, how much of the time when someone asks you if someone is a security, if something is a security or if it's not, how much of the time do you deem that it is? He said 95% of the time. 95%. Another, this is just a little interesting tidbit, because we're all aware of crypto offerings and what's been going on with them. The SEC hates crypto. They believe it's a big giant Ponzi scheme. So they're looking for ways that they can regulate it. And the current commissioner was just recently asked, how many crypto offerings are under investigation? And he said, well, all of them. So if you want to be under investigation by the SEC, go start a crypto offering. Right? Nobody should invite that into their world. Things that we do, we have a lot of free educational content. We do have our podcast, Raise Private Money Legally. We have a pre-syndication retainer. We also do a weekly mastermind for clients only, so you can become a client through our pre-syndication retainer for a nominal fee, and then get invited to our weekly masterminds, where we can help you get really comfortable with these rules about raising money. That's the whole point, is to get you comfortable with talking to investors. And we've seen it do work wonders with some people who I won't name because they might be in this room. Expert syndication. Just kidding. Just kidding. We can help you form your companies, draft the offering documents, and file these securities notices. There's also a lot of articles on our website. We have some with us today. I do have a book. It's a #1 Amazon bestseller called How to Legally Raise Private Money. You can get a digital download of that book right now, or if you want to get the actual physical updated copy mailed to you when it is published, go ahead and scan the card that's on your seat and give us your contact information, and we will make sure that you get an actual physical copy of that book. I don't have it audible yet. So that's what we do. So any questions, anybody?
Here.
And here's that barcode too if you want to scan it up here. Yes.
When you're dealing with a 1031 and they want to invest,
And you're also going to earn a share of the profits, which is going to be somewhere between 25 and 30% of the profits that are generated by that property. That's why you want to be a syndicator, is because that's how you can grow your own wealth. At the same time, you're helping your investors grow theirs. When you bring a tenant in common participant into your deal, you're carving off the portion of the deal that they're buying, and you don't get your share of profits from that. That's an IRS amount of money that you can't raise it